much, Bill. And I'm going to share, hopefully I can do this right. I'm going to share something with you all. Is that coming across? Good. All right. It's good to know I can do something right once in a while. So this is a fairly scaled down report, but I think it provides all the real key information for the third quarter among other periods. And you can see here some of the return numbers. I will say that in addition to the return numbers, two numbers that are very important to us are the United States Conference of Catholic Bishop compliance levels for both the equity and fixed income funds that we manage for the Catholic Foundation of Northeast Kansas. As you may be aware, likely aware, our mandate is to be at least 97% compliant. And on the equity front, at the end of the quarter, we are 97.2% compliant. And on the fixed income side, we were 99.9% compliant, which is great, and we spend a lot of time on from a due diligence standpoint. In regard to performance, you can see for the quarter that the equity fund was up just shy of 6.3%, which was a bit below the benchmark. I'll talk about that in a minute. For the year-to-date period, it's been up about 18%, again, a little bit below the benchmark. And then I will highlight the last 12 months, as you see, in the neighborhood of 31.5%, which again is just slightly below the benchmark. I'll say for the quarter in particular, which makes up the majority of that benchmark gap, we had one solution in particular that is 100% USCCB compliant that was a decent amount below the benchmark. That created the majority of that difference, I would say. The long-term track record for that solution is very, very good. Just had kind of a difficult relative quarter, had good nominal return, but the relativity was a little bit off. I would also say it was an interesting quarter in regard to United States large cap stocks, which typically have led the way the last several years, was a bit of a laggard compared to smaller stocks and international stocks in particular. So kind of a juxtaposition, and that hurt us a little bit, I would say, on a relative basis, but that one solution presented the biggest issue. On the fixed income front, up 3.7 versus about 4.2 for the benchmark, 4.5 versus about 4.7 year to date, and a number for the year that is a little bit different than we've seen for quite some time, but the portfolio is up about 8.25 versus about 9.5 for the benchmark. We have traditionally been a little bit short duration on the fixed income fund, meaning that the benchmark has an average maturity level, let's say, of about 3.8 years, and we've been a little bit less than that, just to reduce the potential volatility with interest rate movements, particularly if they go up, which actually has happened in October so far this month. And also the interest rates on shorter bonds have been more attractive than on longer term bonds, which has been an interesting circumstance. I will say though, since the first of the year, we've increased duration on that front from about 3.1 years up to about 3.5, and with the increase in interest rates this month, our average maturity level as well to get closer to that 3.8 where the benchmark is. So let me pause there just for a moment. Happy to answer any at least initial questions that anybody has on those performance numbers. And what we've included there, as you see, is a hypothetical 60-40 blend, thinking that a lot of constituents, yourselves, may have a 60% stock, 40% bond allocation. And so just, for that line of sight, we provide that on a regular basis as well, though certainly those of you on the line and other fund holders may have a totally different asset allocation. So any initial questions that we might be able to answer? And please don't be bashful. We're here for you and want to help as much as we can. Chance or Paul, do you have any comments on this page in particular?
I don't, Chuck.
Yeah,
Okay.
I don't either. Thanks.
Okay. So let me go to the next page, which shows the makeup of the equity portfolio in particular. As you can see, the majority of the portfolio is in US large cap stocks at 67%. That's been pretty consistent all year in the mid to upper 60s. That's a bit of an overweight versus our benchmark. The next largest position is international developed at close to 19. That is actually a slight underweight to the benchmark, although we've matriculated a little bit higher in that regard throughout the course of the year. And then US small and mid cap, that's SMID, small and mid cap at 6.3, which is a little bit of an overweight. And emerging markets at around 7, which again is a little bit of an underweight. So I guess the theme here is we've been overweighted on domestic stocks and a bit underweighted on international stocks of whatever shape and size. And we always have a little bit of cash in the portfolio, which is actually a money market that has been yielding in the 4.9 to 5.2% level throughout the course of the year so far. And we keep that for distributions and things that come up throughout the course of the year on a somewhat regular basis. Any questions we can answer? I can answer on the allocation for the equity fund. Okay. Paul, any particular comments on that?
Yeah, not really, Chuck. Maybe just sorry if you already said it, but just the benchmark we use for the equity side is a blend of 70% domestic and 30% international. So just as a frame of reference, as Chuck alluded to, we're kind of overweight the domestic part of the portfolio and underweight the international. But just give you an idea of the magnitude of that.
Thank you. And to highlight one thing that I appreciate Bill introducing Chance and Paul, the three of us work together on these portfolios. In addition to us, there are about 45 other people in the Country Club Trust Company organization. And so in addition to the three of us that work directly on the portfolio, we have a lot of people supporting us in regard to research and logistics and other things, but we are for better or worse, we're kind of the face of the situation. So that's why we're on the call today. And then on the fixed income portfolio, as I alluded to, the average maturity right now, let's say it's in about the 3.5 or so year range. It's a very high quality portfolio with, as you can see there in blue, 57% plus in US government securities and about 36% in corporate bonds of various types, all at least A-rated and USCCB compliant as well. Most times people focus on stocks and their compliance with Catholic guidelines and kind of, let's say, forget about bonds. But, we've taken the position that bonds of companies that are not within the guidelines of USCCB teachings should also be excluded from the portfolio. And so we do that as well. And then we have little slivers in mortgage-backed securities and a little bit in high yield bonds, although I think actually this month we reduced or maybe even eliminated. I think we actually eliminated the high yield position. So as you can see at 1.2%, it wasn't a particularly large position. Any questions on the fixed income portfolio.
Chuck, I'll interject a little bit here, and you kind of alluded to it, but
Thanks,
just kind of
Chance.
a more frame of reference there. About 88% is either double A or triple A. And that's actually going to be higher now that we liquidated the high yield because we moved that position into treasuries. So we're looking at 88, 89%, either double or triple A. So very high quality bond portfolio.
Thanks, Chance. I appreciate that. It's a good point. And then before I move on, I want to make sure you see the disclosure so that my compliance people do not show up at my doorstep tonight. I'll just
Chuck,
scroll up.
before maybe you comment on the economy as a whole,
Yeah,
our fund holders have the ability uh, to choose an asset allocation between amongst the equity fund, the fixed income fund, and a money market fund. And would you comment on just some high level philosophy on how they may want to be thinking about that in terms for an endowment fund with a long-term time horizon?
sure. So, I mean, this may not be foreign to most, if not all of you, but with as Bill presented, with a long-term time horizon, we typically recommend, see institutions again gravitate towards a higher percentage in stocks and equities. I would say of at least 60%. Institutionally speaking, maybe up to 70% plus. Once in a while, we see some below 60 at 50, but it's pretty rare to see below 50, and I can count on probably less than one hand the situations that are in the 50s. I would say the sweet spot is in the 65 to 75% equity position. And for the most part, there'll be some money market or cash position, and we always have, as you saw on the pie charts, there's always some cash in the portfolio. So even if you don't gravitate towards having a particular position in the money market fund that you have available to you, there's always some cash. I'd say a couple percent ish in the portfolios. So if you look at that from an asset allocation standpoint, I wouldn't be overly concerned about that. Now, if you have a distribution that's coming up shorter term focused, you might want to shift some to the money market. But other than that, it's I think wise historically to be focused more on equities, certainly. So.
Yeah, one of the things, Chuck, to just to remind everybody, for the most part, almost all of our endowment funds, you have the ability to withdraw 4% a year. So our goal is to, far exceed the 4% so that you can take distributions and grow the funds at the same time. And I think that's the ideal scenario.
Yeah. Yeah, and you can see that in this page, although the 3-year number, which includes 2022, which, if you remember, was not the most pleasant year in the markets, not only stock, but also bond wise as well. Even with that, really difficult year due to the last 2 years being excellent. We still are above that, and certainly the longer term numbers are significantly above 4%, and certainly the 1-year number has been excellent. So that there's kind of a gyration. Unfortunately, things don't grow in a linear way, but certainly over the longer term, that's historically been the way to go. Super fruitful.
If we're at 80-20, are we gambling too much?
Jim, I mean, I would say that's a little bit higher than the norm, but I don't think so. I think, actually, I think from a academic standpoint, and if you with a long-term horizon, if you're able to emotionally, ride those waves, I don't have any issue with an 80-20 portfolio at all. I typically institutions that have a fiduciary board to report to don't do that because they don't want to have those discussions with the board. But if the organization has a comfort level in that regard, I think academically that's actually a great approach and should be
Okay.
provide a good outcome over 5, 10, 15, 20-year period for sure.
Yeah, I always tell our finance council, I only report to them when it's good news.
That's right. Yeah, my fear actually, to maybe respond to your point in a different way, Jim, is that councils are more apt to go 20% in stock because they don't want to have those discussions and like in a night 2022. And although that you avoid those discussions by and large in those years, you really don't get the outcome that you probably should be looking for either. So I would definitely encourage people to be open-minded about having a higher equity position than a lower one, certainly.
Okay, thanks.
You bet.
One last question, one quick question. Are these slides going to be available to us or Bill?
Yeah, we'll make them available. They might be on our website already, but we'll make sure they are, Jim.
Okay, thanks.
Yeah, I know there's some things on the website, but I'm just not sure this one is, Bill, but I know some are. Other questions?
I guess, Chuck, I don't know if you're going to jump into any of the economy or an outlook, but
I'm
next
happy to
a week from today, it's going to be a different world we're living in. And so, any thoughts on the election and how presidential elections impact the markets?
Sure. So I hope we know a week from today who our next president's going to be. I think that's the biggest, let's say, non-political issue. I'm not going to talk about who people should vote for or who I'm voting for, but my one concern I would say in the whole process is that next Wednesday, Thursday, Friday, a week from next Friday, we still don't know who our president-elect is. I think that would cause some concern in the market, given the polls, the closeness of the polls, and to be honest, there are a couple of states that are very slow in their conclusions. I think Wisconsin is somewhat in that category, but ironically, Pennsylvania, which is a hot spot, has a kind of a slow process that played out in the last election and may do as well, just because they don't start counting any ballots, I think. If I remember right, till the close of their polls, there's no earlier process, and that causes somewhat of a delay. So if we're waiting for Pennsylvania to come through to kind of make the decision, it may be a little while. The markets will probably be a little jittery if that's the case, as that is an elongated process potentially. Aside from that, trying to figure out what the market is going to do based on the end result is very difficult, to say the least. And the market typically doesn't care one way or the other. Some of the subcategories may gyrate, one way or the other, thinking that if Vice President Harris is elected, this sector may benefit or that sector may see some detriments. But even if she or former President Trump get elected, getting things enacted is kind of a rough process at times because they have to work through Congress as well. So promises that are made in the election sometimes come to fruition, and a lot of times, as many of us maybe have experienced, do not, and changing positions materially one way or another based on those very preliminary thoughts and I'll say promises can be to our detriment as an investor. So I would say sticking to our knitting, asset allocation wise, and not being overly aggressive and making material changes even in the sub asset classes is probably the best thing to do. I mean, the economy seems to be on good footing. Inflation, although it's I guess it's somewhat debatable, has been reined into, at least to a degree, where the Federal Reserve, as we all know, reduced rates last month and may do so again in November and December. The gross domestic product numbers seem to be real domestic. They seem to be in good shape. There are some indicators that are negative, but there's some other ones that are positive. Labor has kind of gone back and forth a little bit. Housing has kind of gone back and forth a little bit, but manufacturing as well. But by and large, the consumer seems to be in good shape. The consumer is spending, and we don't necessarily see a recession in the near future. And it looks like maybe the Federal Reserve has piloted the soft landing that it had as its goal. So. Anything else anybody would like me to touch on? Paul or Chance, anything on the crystal ball front you would like to add?
Nothing on my end, Chuck.
It's full. Chicken.
Crystal ball is fuzzy today.
I know. I will say this. As you can see by my gray hair, I've been at this for a while, and I've seen many people make moves based on one piece of information, thinking that extrapolates to a particular end result. And I just, my opinion after all these years is the world is a matrix, particularly on the economic front, and there are a lot of things that come to play. And taking one piece of information and making big changes based on that tends to lead to less than optimal results. I'll just leave it at that. So. Bill, I'll turn it back to you unless anybody has any questions.
All right. Well, thanks, Chuck and team. That was good, and thanks for those questions. A couple of things from the Catholic Foundation perspective. Next week, we will be sending out to all of our fund holders our first, what we're going to do, quarterly packet of information on a different way to give so that you can promote this at your parish, school, institution. We're going to send out a little packet with bulletin announcements, things you could use on your social media, on qualified charitable distributions. It's important to promote those all year long, but as we get close to the end of the year, it'll be a great way to pick up some year-end giving for you. So look for that. And in addition to being good stewards of the funds, it's always a great practice to look for ways that you can increase the size of your funds so that those distributions will grow and benefit your ministry. One of the other products that, if you are a financial advisor, if you know people in your parish that are using donor advised funds, always remember that the Catholic Foundation offers a donor advised fund product. We offer a Catholic donor advised fund. It is managed by Chuck and his team, so it's managed with using those same funds. So they're invested in accordance with the Catholic principles, and it's a great way to pass on your Catholic legacy to family members as well. And then lastly, always check out our other resources on CatholicPlanGiving.com. Is a great website that has all kinds of gift planning ideas, and it's a great place to refer people to. If you have parishioners or donors that need help, always feel free to reach out to us at the Catholic Foundation. We'll be glad to sit down with them on your behalf and help them with their gift planning. So, and then lastly, I guess that wasn't last, so now it is. Check out our events tab. We have a great lineup of events. I know we have one up in Leavenworth tonight on tech strategies for giving. So I know Jane would like to see a few others show up, and that would be great. And we have some up in Topeka next week. We have a Catholic Advisors Network event. And I think we have some Wills and Trust events coming up as well, but check out our events page for more information on that. To, again, learn about ways to give and ways to increase the balances in your funds for your institutions. So if there are any questions, we can take them now, or if anybody else from the CFNEK team has anything to add, jump right in.
I'll just say thank you, Bill and team, for, putting this together. We appreciate being a part of this, and we certainly appreciate all the constituents on the line and all that art and their support of CFNEK. And it's an honor to serve the organization. It's an honor to serve all of you at the organizations that you represent as well.
All right. Well, again, thank you. We will be doing this again in late January with the December wrap up, and we'll look forward to seeing you all there. And like I said, if you're on one of your finance committees, invite your fellow members so they can hear this next quarter. So thanks to Country Club Bank for all you do for us, and we'll see you all in a few months. And have a happy Thanksgiving.